And so when we talk about defining what the word cost means to you, it clearly from a consumer perspective it means one thing, but from an accountant or an organization's perspective it may mean something very different, or getting to the same understanding may take very different routes. And so what we want to do is to talk a little bit today about the different routes involved. So we'll define and illustrate what a cost objective is. We'll distinguish between direct cost and indirect cost. We'll distinguish variable cost and fixed cost from one another. We'll work to interpret unit costs cautiously and what that may mean for us as we use those unit cost measures in our calculations. We'll distinguish between inventoriable cost and period cost, and we'll illustrate how the flow of journal entries and costs are with respect to inventoriable cost or period costs. Our final objectives are to explain why product costs are computed in different ways for different purposes, and to describe a framework for cost accounting and cost management considerations and decisions. So with respect to some of our basic terminology, we talk about ideas like cost, which is really a sacrificed resource to achieve a specific objective. So I'm sacrificing, I'm giving up something in order to get something in return. When we talk about actual cost, we talk about a cost that has occurred. We talk about budgeted cost, we're talking about some predicted cost that we expect or anticipate to occur in the future. And we talk about a cost objective, we talk about anything for which a cost measurement is desired. And so this idea of cost objective, if I manufacture computers, one of my cost objectives might be how much does it cost me to manufacture a specific computer. If I manufacture gasoline, one of my cost objectives might be how much does it cost me to produce a given lot of gasoline, and I may have a cost objective that's as granular as 1 gallon. I may be satisfied that I have a cost objective that's as granular under a process manufacturing for 1,000,000 gallons. And so a cost objective can vary depending on what we are trying to cost across products. So it's kind of important to keep in mind that we're not just necessarily talking about what's it cost me to make 1 coffee cup, or what's it cost me to make 1 chair. We could be talking about process manufacturing organizations where I'm interested in what it costs me to make 5,000 linear feet of lumber or of wood flooring. So there's very different answers to what a cost objective is. Managers use cost information in 2 main ways: when making decisions and when implementing decisions. If you recall, we had our decision-making process or framework that we talked about in Chapter 1, where getting what our alternatives are and choosing between one of those alternatives, and then evaluating the performance of our decision process is very important and is something that managers do every day, day in and day out. And so again, when we are thinking of costing something, it is a particular something, a car, piano, a new outfit. It's that thing about which we want to know the cost. That is what we call a cost objective. And so in here, in this slide, we just see some examples of different things about which we may want to know the cost. And so, for instance, maybe we want to know the cost of a product, a BMW X6 sports activity vehicle. So that involves certain items, certain raw materials, and certain raw labor costs, and then certain indirect costs. Maybe we want to know what a service costs us. So if we're providing a telephone hotline, providing information and assistance to BMW dealers. Maybe we want to know a specific project. So we have a project that we started that involves the research and development project on the DVD system enhancement in the BMW cars we're producing. Maybe we want to know the cost of a particular customer. Maybe we want to know the cost of a particular activity, and we'll talk about activity-based accounting later on. Or maybe we want to know just a departmental cost. So what's our environmental department cost us, or what's our health and safety department cost us, or what does our accounting department cost us? So as you can see, there are a lot of different dimensions to this idea of a cost objective. And so some additional terminology that we need to consider is this idea of cost accumulation, which is a collection of cost data in an organized way by means of an accounting system. We have a cost assignment, which generally encompasses the gathering of accumulated costs to a cost objective in two ways. One is tracing accumulated costs with a direct relationship to the cost object. Another is allocating accumulated costs with an indirect relationship to a cost object. So it can be direct in the sense that I'm buying tires for my BMW, I'm buying steering wheels for the BMW, I have direct labor that's assembling the BMW. It may be indirect in the sense that that BMW is being manufactured in a manufacturing facility that has utility costs, it has rent, it has leases, it has taxes. The machine, the assembly line that the vehicle is being manufactured on has certain repair and maintenance and insurance and tax costs. Those are ideas or examples of the indirect costs associated with it. One way we differentiate between different kinds of costs is to identify them as either direct or indirect. Direct costs can be conveniently and economically traced or tracked to a cost objective. Indirect costs cannot be conveniently or economically traced or tracked to a cost objective. Generally, instead of being traced, these costs, that is indirect costs, are allocated to a cost objective in a rational and systematic manner. So an example of this would be the salary of a plant administrator at BMW. That would be an indirect cost of a particular automobile because unlike the steel or tires used, it is virtually impossible to trace plant administration to a particular car line. And even if it were possible, with all the new technology we have, the issue would be, is it cost beneficial? Do we get that much more information about what it cost us to make a vehicle if we charge those or somehow attach those those plant administration costs to specific vehicles versus allocating them to a vehicle in a systematic and consistent way based on some causal relationship? And we'll talk about that more when we start talking about the allocation of indirect costs. And so going back to our X6 BMW example, we see here an illustration of how costs for that line would be collected to the cost objective. The direct costs can be traced, but the indirect costs are allocated. Added together, we obtain total costs for the cost object, or the BMW X6. And so to gain a better understanding of the types of items that fit into each type of cost, that is direct or indirect, here are some examples. So direct costs would include things like the steel or the tires for a car and the assembly line wages. Those are items that can be directly tracked or traced in a cost-beneficial manner to a single cost objective, that being the BMW X6 example. Indirect costs such as electricity, rent, property taxes, plant administration expenses, these are items that clearly the BMW X6 benefits from. We got to have electricity to keep light in the factory. We got to have rent to pay the factory where it's assembled. We got to pay property taxes if we have a factory. So clearly there's a benefit from these costs, but the issue becomes one of, okay, well, how much would it cost us to directly break these costs down to the same level of detail to go against an X6 cost object like we do direct cost, and would we receive enough enhanced decision making as commensurate with the additional costs incurred? So one way to think about this association between the direct cost and the specific requests for those items in the production process. We need 4 tires and X pounds of steel for each car, but we don't requisition some number of hours of administrative time or requisition some amount of rent for each car or for the line. And so managers are generally more confident about the accuracy of the direct cost of cost objects. And in a lot of ways, this is simply because they don't understand the cost allocation methodology, or this idea of direct versus indirect cost doesn't resonate. And quite honestly, and a lot of times it's because the time was never taken to explain it very thoroughly or accurately to them. So a few factors affect the direct-indirect cost classification, and they include the materiality of the cost in question. So the smaller the cost, the less likely it will be efficient to trace the cost, and the more likely that would be then treated as an indirect cost. The available information gathering technology. So obviously technology, because we've come so far there, allows us to treat more and more cost as direct. And then the design of operations, if a part of the facility are dedicated to a particular cost objective, we're generally able to classify more cost as direct. And that's because there's this idea of a causal relationship, and if, even though these items might be considered or thought about as being indirect in nature, because we have the design of operations says that one whole area or one whole part of our plant may be associated with the manufacture of a particular car, it makes it easier, because there's a 100% causal benefit relationship, it makes it a little bit easier sometimes to treat that otherwise indirect cost as direct. So, and keep in mind too that a specific cost may be direct for one cost objective and an indirect cost for another. And so cost behavior defines how costs change. That will be in total with a change of activity, variable cost per unit with a change of activity. Another way to look at this is that variable costs are constant on a per unit basis. If a product takes 5 pounds of materials each, it stays the same per unit regardless if 1, 10, or 1,000 units are produced. Fixed costs change inversely with the level of production. As more units are produced, the same fixed cost is spread over more and more units, reducing the cost per unit. Costs are defined as either variable or fixed for a specific activity and for a given period of time. When considering variable and fixed cost, it's very important to know if you're looking at the cost in total or per unit. So variable costs change in proportion to changes in the related level of activity or volume of output produced, whereas fixed costs remain unchanged in total for a given time period despite changes in the related level of activity or volume of output produced. And so think about our BMW X6 model. If we take the 4 tires and they cost us $500 a piece, that's $2,000 per vehicle for the 4 tires that go on it. So if we produce 1 vehicle, it's $2,000, 2 vehicles is $4,000, 3 vehicles is $6,000. So those costs change proportionally to the level of output versus our manufacturing facility, which has a per month rent of, say, $1 million. And quite honestly, it doesn't matter, as within our relevant range, right? And that's generally a capacity-driven consideration. It doesn't matter whether we produce 1 vehicle or 100,000 vehicles, as long as the 100,000 vehicles is within the relevant range that we're talking about for the amount of rent we're talking about. It doesn't matter whether it's 1 or 100,000. We're still paying $1 million worth of rent. And so that kind of is a good example of the difference here in variable costs that change proportionally with the level of output versus fixed costs that don't really change in total across a level of output within a specific relevant range, but if you average those out over the number of units produced, they do change as an average of the per unit cost. And so in this chart, we have a summary of the way our costs change in total or per unit. Variable costs total dollars change in proportion with output but remain unchanged per unit. Fixed costs total dollars remain unchanged in relation to output but change inversely per unit. And so in these charts, we see the graphs for variable and fixed costs using the number of steering wheels for the BMW X6. Panel A shows a graph of the total variable cost of steering wheel. The cost begins at 0 because if we make no X6s, we'll incur no cost for the steering wheel. Fixed costs are presented in Panel B, where we have the line across at $2 million mark. The annual total fixed supervision costs for the X6 are the amount that would be that amount whether we assemble 0, 20,000, 40,000, or $60,000 or 60,000 cars. So again, this is just meant to show the difference visually between this idea of a variable cost and a fixed cost. And the reason that the panel A intersects at 0 is that for variable cost, if we produce nothing, we buy nothing because we don't need any raw materials or any variable cost at a 0 level of production. it intersects at the supervisory, for panel B, it intersects at the $2 million range because we have to have some level of plant supervision. Now granted, that's scalable, and it may be not a completely straight line, but a line certainly that doesn't have the same slope as the panel A line. And so just a few other additional concepts. We talk about a cost driver, and that's the variable such as the level of activity or volume that causally affects costs over a given time span. So the cost driver might be something like the temperature. A cost driver for the utility bill may be the temperature. The higher the temperature, the higher our utility bill. The lower the temperature, the higher our utility bill. But the more moderate the temperature, the more moderate the utility bill. So the cost driver of temperature impacts the level of cost. The relevant range, and that's the band or range of normal activity level or volume in which there is a specific relationship to the level of activity or volume and the cost in question. So think about a manufacturing facility. I might rent a manufacturing facility that allows me to produce between 0 and 1 million units per month, but if I produce more than 1 million units, I don't have capacity, and so I have to go out and rent another manufacturing facility in order to produce more than 1 million. So my relevant range is between 0 and $1 million for the rent involved in that manufacturing facility. And then, so the idea of relevant range is that at some point of increased production or assembly, fixed costs will likely increase. So if, for example, if we were to run out of capacity and need to enlarge the facilities, there will be additional cost involved. Those additional costs would be fixed in nature and not variable. So we've introduced two major classifications of cost, the direct and indirect, and the variable and fixed. As a result of that, we can have the following combinations of costs: direct and variable, direct and fixed, indirect and variable, and indirect and fixed. We've been discussing how variable costs and fixed costs differ in terms of their unit costs. For this reason, unit costs should be used cautiously. Because unit costs change with a different level or output of volume, it may be more prudent to base decisions on a total dollar basis. And so once again, using the BMW X6 as an example, we see here examples of the various combinations that can occur for direct and indirect versus variable and fixed. And so a variable direct cost would be something like tires used in the assembly of automobiles. Barring quantity discounts, the variable costs are going to change in proportion as a direct cost to the number of BMW X6s produced. That contrasted with the variable cost and indirect costs such as power plants, where power usage is metered only to the plant where multiple products are assembled. And then we see some more examples with respect to fixed direct cost or fixed indirect cost. So cost accounting is used for all types of firms, including manufacturing sector companies who produce materials and components and convert them into finished goods, or purchase materials and components and convert them into finished goods. Merchandising sector companies that purchase and then sell tangible products without changing their basic forms. So think about a merchandiser at the mall. They don't make anything, they don't manufacture anything, they simply buy, sometimes in bulk, and then resell that to mall visitors. That's a merchandiser. And then service sector companies that provide services. Those are intangible products like legal advice or accounting services or engineering services. They provide services, not something hard and tangible like what a manufacturer may make or a merchandiser may resell. And then we talk about types of inventory. Manufacturing sector companies purchase materials and components and convert them into finished goods. These companies typically have one or more of the following three types of inventory. So direct materials, that's resources in stock and available for use. Work in process or progress, that's products started but not yet completed, often abbreviated as WIP. And then finished goods, which are products completed and ready for sale. So if we think about that, think about our BMW. We have direct materials, which are tires and steel and doors and windows and doorknobs and steering wheels, all sitting in a raw materials inventory somewhere. When we pull those to literally place them in the manufacturing process, we create and move them from a raw material store to a work in process account. And then once we've completely assembled the product and it's ready to be shipped out the door, we transfer them out of this work in process account to this finished goods account waiting for final sale. Just note that merchandising sector companies only hold one type of inventory, that's merchandise inventory. So obviously they don't have any raw materials like a manufacturer will. Three terms are commonly used when describing manufacturing cost. These terms build on the direct versus indirect cost distinctions we've already discussed. And so we have direct materials, which is the acquisition of all materials that will become part of the cost objective. We have direct labor, which involves the compensation of all manufacturing labor that can be traced to the cost object. And so just be reminded that in each of those terms we have this idea of direct, right? Direct materials, direct labor, and then we have indirect manufacturing. And these are factory costs that are not traceable to the product in an economically feasible way. And those might include examples such as lubricants for the machinery used, or indirect manufacturing labor to repair and maintain the machinery used, or the janitorial costs to clean the warehouse, utilities and supplies. These costs are all known as inventoriable cost. So now let's talk about the distinction between inventoriable cost and period cost. Inventoriable costs are all costs of a product that are considered assets in a company's balance sheet when the costs are incurred, and that are expensed as cost of goods sold only when the product is sold. For a manufacturing company, all manufacturing costs are inventoriable costs. Period costs are all costs in the income statement other than cost of goods sold. They're treated as expenses of the accounting period in which they are incurred. So let's switch gears now and start our conversation about the flow of cost. Cost will flow from the balance sheet to the income statement, or will originate on the income statement. So let's take a closer look at this idea. In this example, we see representing the flow of cost through the balance sheet accounts for inventoriable costs only and into the income statement for both inventoriable and period cost. And so we can see if we begin on the left-hand side with inventoriable costs, we have direct materials, direct manufacturing labor, and manufacturing overhead cost. And they are all working their way through the balance sheet. Direct materials is moved into direct material inventory when it's received. When we pull it out of direct material inventory to go into the production process, we move it into a work in process inventory. Direct labor goes into the work in process inventory, and manufacturing overhead also goes into work in process, and it's accumulated there throughout the manufacturing process. Once the manufacturing process is completed and the goods are ready to be sold, we move these costs out of WIP into the finished goods inventory where they sit pending a sale, and then once they've sold, we move them out of finished goods inventory onto the cost of goods sold, which is an income statement account. And so on our right-hand side, up to that point, on our left-hand side, we were dealing with the balance sheet. You can see on the right-hand side now we flip to an income statement where we have revenues from which we deduct our cost of goods sold to get us to a gross margin, from which we deduct these other period costs, and those are again items like research and development costs, design, marketing, distribution, or customer service costs to get to an operating income level. And so this is just a good example of how these costs that we've been talking about, direct and indirect, flow through the balance sheet for manufacturing firms and onto the income statement. And so to report the flow of cost just illustrated on the income statement, we calculate cost of goods sold as the beginning finished goods inventory plus the cost of goods manufactured, which we'll talk about next, which equals the cost of goods available for sale. So think about it. So it's our beginning cost of goods manufactured plus the cost of goods manufactured that we incurred this period. We then subtract the ending finished goods inventory, since we haven't sold those yet and they're still available for sale. They're still in our inventory account to get us to cost of goods sold. And then when we subtract our cost of goods sold from net revenues, we get our gross profit. Then from our gross profit, we subtract the period cost that we just looked at, the R&D, design, marketing, distribution, customer service cost, to get to our operating income. So this is just a quick development of an income statement based on that flow of costs we just looked at. So from our first panel on the multiple step income statement, we used a figure called cost of goods manufactured. So how do we get to that cost of goods manufactured? And one step is to calculate the cost of direct materials used by adding beginning direct materials to purchases, then subtracting out ending direct materials inventory. Step 2 is to calculate the total manufacturing cost incurred, which includes the cost of direct materials used plus direct manufacturing labor plus manufacturing overhead. And then in step 3, to beginning work in process inventory, we add the manufacturing costs incurred that we just calculated. This gives us the total manufacturing cost to account for. In other words, these costs will either remain in work in process or they will be transferred to finished goods. Continuing on step 3, we subtract the ending work in process from total manufacturing cost to account for. We get the cost of goods sold or cost of goods manufactured that we used in the last slide. And so 2 additional terms we use to describe cost classifications in manufacturing costing systems are prime cost, and those are referring to all direct manufacturing costs, materials and labor, and conversion costs, which is a term referring to direct labor and indirect manufacturing costs. And so up until now, we've been fairly logical and seemingly absolute in how we define these terms. But remember that there are alternative ways for management to define and classify cost, and that judgment is required. Managers, accountants, suppliers, and others should agree on the classification and meanings of the cost terms introduced into this chapter and throughout the book. So just be mindful of the fact that sometimes it's not as clear-cut and as black and white as we're tending to make it out here. Many cost terms used by organizations have ambiguous meanings. Consider the term product cost as an example. A product cost is the sum of the cost assigned to a product for a specific purpose. Some different purposes might include pricing and product mix decisions, decisions about pricing and maximizing profits. Could be contracting with government agencies, which have very specific definitions of allowable costs for cost plus profit contracts, or preparing external use financial statements, which are GAAP-driven or generally accepted accounting principles driven. These different purposes can result in different measures of product cost. And this illustrates how these different purposes can result in different measures of product cost. So this framework for cost accounting and cost management can help managers make decisions. So one is calculate the cost of products, services, and/or other cost objectives. Obtaining information for planning and control and performance evaluation, and then analyzing the relevant information for making decisions. And if you recall, these were the 3 final steps in our decision-making framework that we talked about in Chapter 1. And so this concludes Chapter 2. I encourage you to read the chapter and, again, not allow this discussion to substitute for a good read. It's an important chapter because it defines and lays the groundwork for a lot of terms that we'll use throughout the semester. And if you have any questions or concerns or problems, I encourage you to discuss this with the course facilitator. And thank you.